Hello everyone, I'm Ingram from AllQuant. Great to see you all again. Now, in one of my earlier videos, I introduced to you the concept of beta, right, in investing. And today, I'm going to talk about a sibling. Yes, all right, it is another Greek term. It is called alpha. Now, alpha and beta are like two good brothers that go hand in hand, right? And they're usually applied on stocks, portfolios, or funds that invest into stocks itself. And this will also be the context which I'll be using when I talk about alpha and beta over here. All right. Now, to understand how alpha and beta are related to each other, it is actually more intuitive to come from the perspective of attributing returns. Now, let's say, for instance, you have a US large cap stock or a portfolio of US large cap stocks. Think for a moment, what are the things that could be driving the returns of this portfolio? Can you break these returns down into different, distinct components? If you think logically, no matter what we invest in, we will need to be at least compensated for cash returns. And what is cash returns? It is simply what you would have gotten by parking your money into a safe investment such as US Treasury bills, which is virtually free of default risk. And why is that the case? Because if we don't even get such a return, then why bother to go through all the hassle, to do all the research, and then invest, right? Now, in this cash returned component is what we call the risk-free rate. All right, it is what you could have gotten out of safe liquid investments like treasury bills, which I just mentioned earlier. And this is your first component. Now, besides the risk-free rate, what is another very obvious component here? Okay, so since you're invested into a portfolio of US stocks, you would definitely expect yourself to be compensated for the risk for holding on to these stocks, isn't it? Right? Makes sense? And this compensation is going to come in the form of the returns from the broad US stock market minus of the risk-free rate. And this portion here, we call it the equity risk premium or the market risk premium. This is basically what you would expect to earn over and on top of the risk-free rate if you invest into US stocks. But how much a portfolio is going to get out of the market premium depends on your beta to the portfolio. So a quick recap here, beta indicates how much exposure your portfolio has to the stock market or how sensitive, right, it is to the stock market movements. And if you want a more complete explanation, please go back and watch my video on beta. Okay, so I'm not going to delve back into the details here. All right, and basically this is the second component. We're almost there. There is only just one last component to complete the entire puzzle here, and that is your alpha. All right, what we're going to talk about today. So what does alpha represent here? If you look purely from a mathematical perspective, alpha is simply whatever remains of your portfolio returns that cannot be attributed or explained by the risk-free rate and the market premium. And what is one possible thing that could explain this difference? It is the skills of the investor or the fund manager in selecting the right stocks. So if a fund manager is good, then you can expect him to add positive alpha. So that means the returns coming from his portfolio exceed what can be attributed to the risk-free rate and the market risk premium components. So that is his value add. But if he sucks at selecting the stocks, okay, then he could end up with a negative alpha. So that means his portfolio is less, or the returns from his portfolio is less than what one could have gotten by investing into, say, a passive index on the broad market. So if you put all these pieces together, we get a complete equation or the formula that describes the portfolio's return. Okay, and that is the return of the portfolio is the sum of three components here. First is your risk-free rate, right? And second is your exposure to the market risk premium. And finally, third one, your alpha. Okay, and for those who have some background in finance, you will know that this particular portion of the equation here, without the alpha, right, is actually your capital asset pricing model or the CAPM model, which is used to estimate expected returns of stocks and portfolios. So again, if you can look at it this way, if the portfolio has positive alpha, that means it is delivering more returns than what we expect it can make out of the market using the risk exposure you took. But if you have not heard of CAPM, that is perfectly fine as well. No, there's no need to fret over it. Okay, so what is more important here is that you understand the intuition behind this formula here. I'll be showing you how you can calculate alpha on Microsoft Excel in this section here. Now, it is something that is good to learn, but if you are not interested in technical implementation, do feel free to skip this part and then move on to the next section. And you can navigate around, right, using the timestamps in the YouTube description below. All right. Now, the method used to calculate alpha is similar to that for beta. Essentially, what we need to do again is to perform a linear regression. Okay, but this time around, we are regressing the return series of the portfolio against the market risk premium. Okay, so this would generate the best fitted line across the data points, and the slope of this line again gives you your beta, and the intercept is going to give you your alpha plus the risk-free rate. So just subtract off the risk-free rate from the intercept and you will arrive at your alpha. Now let's see how we can do this in Excel now. All right, so what we have here is the daily price series of 3 securities. We have that for SPY, which is the S&P 500 ETF, and we're using that as the reference market for this exercise. And we also have the daily price for Apple and Walmart. There is a total of about 1 year worth of data down here. And with all this daily price data, we can proceed to the next step to calculate the daily return series for these 3 securities, which are required, right, as inputs to the linear regression. So let's start with SPY. Okay, insert the formula equals to today's price divided by your previous day's price, and then you subtract 1 from it. And that is going to give you the daily return for the 9th of November 2021. Well, after this is done, drag the cell right to the right all the way to Walmart to replicate the formula. Then just double click down here to replicate the formula all the way down to generate the entire return series. Okay, so once this is done, let's focus on this next column, which is the daily return series for an equal weighted portfolio. And this equal weighted portfolio just means a 50% allocation to Apple and a 50% allocation to Walmart. And for simplicity, let's assume that we manage to rebalance this portfolio every day to maintain the weight at 50-50, and there are also no transaction costs involved. So in that case, I can just calculate a return using the average, right? The formula average, this average function down here, right? The average across Apple's daily return and Walmart's daily return. Okay, close the bracket and hit enter. And this is going to give me the daily return of the equal weighted portfolio, right? Double click here and replicate the formula all the way down. And then the last column, I'm going to calculate what we call the market risk premium. And if you recall, the market risk premium is just simply your market return minus away your risk-free rate. And in this case, the risk-free rate, I've assumed it to be 0.005%. Okay, I'm using a daily risk-free rate down here, okay, not your annual risk-free rate. So this is a very small number down here. All right, so what I'm going to do now is just going to take equals to your market return, okay, minus away your risk-free rate. Okay, and I'll have to fix this cell here, right? Just put a dollar sign in front of an L and a dollar sign in front of a 2, right? You can press F4, right, just for the shortcut key to do that. Okay, just hit enter on it. And this gives me the market risk premium for this particular date. And then just replicate the formula all the way down like how we did it for the previous columns. Okay, and you get the market risk premium column done as well. Okay, so now we are ready to calculate the beta and the alpha. So the first I'm going to start with is to calculate the beta of Apple. Okay, and if you recall in my previous video, you can make use of the slope function, right, in Excel. Slope, right, open a bracket, and you need to regress basically Apple's returns, right, against the market returns or the market risk premium, right? Either column is fine. They will return you the same results. Okay, so in this case, I will just make use of the market risk premium column here. Okay, and then we hit enter, and this is going to give me the beta of 1.26, right, which is Apple's beta, right? And I'm going to calculate the same thing for Walmart, again using the same function, slope function, but this time I will need to supply this function with Walmart's return series, right, followed by the market risk premium. Okay, then hit enter, and 0.41 is the beta for Walmart. Okay, and as for the equal weighted portfolio, it's exactly the same process using the slope function. Okay, but this time I take the return of the equal weighted portfolio and then I regress it against the market risk premium. Okay, close the bracket and hit enter, and I get 0.83. That's the beta, right, for the equal weighted portfolio. Now let's work on the alpha here. So what is alpha? Alpha is just simply the intercept, right, of the same linear regression that we are going to do minus off the risk-free rate. All right, the intercept minus away the risk-free rate, that gives you your alpha. Okay, so I'm going to make use of this function code intercept, right, intercept, and I'm going to regress your Apple's returns here, right, against your market risk premium. Okay, all right, but we're not done yet. We still have to subtract away the risk-free rate. Okay, minus it off. And that gives us 0.08%, which is Apple's alpha, right? And what about Walmart? Just simply do the same thing. Use the intercept function. Okay, and this time you use the Walmart's daily return series, right, against the market risk premium. Okay, after that you subtract away basically your risk-free rate again. Hit enter and you get an alpha of 0.02% for Walmart. And finally, we can do that for the equal weighted portfolio using the same procedures, right? Equals to intercept, okay, the daily return series of your equal weighted portfolio against your market risk premium, and minus off your risk-free rate. Okay, hit enter on it, and then you get 0.05% as the alpha for the equal weighted portfolio. All right, so basically that's how it is done. Once we have both the alpha and beta of a fund or the portfolio, that means we have a rough estimate of what is driving its returns. And it can be very useful, right? For example, we can know how good a fund manager is and what is actually using to get his returns. Is he riding more on beta, or does he have some genuine stock selection skills? Okay, a fund manager that delivers more return than another one may not necessarily mean that he has more skills or alpha, right? Because he could have been taking on more beta, for example. And as an illustration, let's look at these two fund managers here. We have Jim and Jane. Okay, they both run a US large cap fund, and a suitable reference market for them will be the S&P 500. So Jim delivers 9.5% and Jane 10.5% on an annual basis over the past 3 years. So without any further information, you're more likely going to go for Jane, right, as the better manager. But if you break down their returns, you actually realize that Jane's portfolio is driven by high exposure of beta, right, to the market. And the alpha, when you calculate it, is in fact negative. Jim, on the other hand, runs a lower beta with a positive alpha. So he actually added more value to the portfolio, presumably, right, through stock selection skills. And also because its portfolio runs a lower beta, it is actually less sensitive to changes in the market itself. So with all this new information on hand, you may now have a different opinion. There can be more than one factor that drives the portfolio return. So alpha is just an output from a linear regression model. So strictly speaking, it should just be viewed as returns that cannot be explained by the model itself. But in a way, right, we kind of conveniently attributed all those, right, to being skills of the manager in selecting the stocks. But is it really the case? It is both a yes and no, right? Or at least not all of it are due to his credit, because there can be other factors that drive the returns of the portfolio, right? Aside from market risk premium. Okay, so there are also factors like momentum, value, and size, which have been well studied and documented. Okay, and you can also run a multi-factor regression in this case to find out what should be the multi-factor alpha. So it all depends on how you want to slice and dice the problem at hand. Next, alpha changes with time, right? Just like beta, alpha is not a constant. It can change with time. For example, alphas have been known to diminish over time as markets get more and more efficient and more people come on board to exploit the same strategies. Okay, and lastly, alpha is also an estimate. And again, similar to beta, it is a statistic. So there will always be uncertainties around it when you use it to make investment decisions. All right, that's all, folks. Time to call it a day. Now, before I end, please remember to hit the like button and subscribe to our channel if you have not done so. And if you want to know the courses we offer at AllQuant, do come over to our website. The link is in the YouTube description below. And finally, here's wishing all of you a very blessed Christmas and Happy New Year ahead. Bye-bye, right? And I'll see you again next year.